The biggest bank in the US has announced that it lost $2 billion in risky trades over the past 6 weeks. We ask if this strengthens the case for more Wall Street regulation. You're watching Inside Story Americas from Washington. Hello, I'm Scheer. Some leading politicians in the US Congress are demanding that federal regulators strengthen proposed banking rules and scrutinize trading more closely. It follows that $2 billion trading loss disclosed last week by JPMorgan Chase. Heads have already started rolling with the resignation on Monday of the bank's chief investment officer, Ina Drew. Some regarded her as the most powerful woman on Wall Street. That bad trade strikes at the heart of the debate about Wall Street regulation. The loss will not cause the bank to collapse, nor will it need a government bailout. But the news has intensified the belief for some that banks should not, or perhaps cannot, regulate themselves. Since the most recent economic meltdown, which many say was caused by financial institutions taking excessively risky bets, the federal government attempted to reform banking regulation in a piece of legislation known as the Dodd-Frank Wall Street Reform and Consumer Protection Act. It passed in 2010. But many of the regulations contained within the act have not yet been implemented, largely because of opposition from Wall Street lobbyists. They say the reforms go too far and would restrict the ability of banks and other financial institutions to make loans. JPMorgan's chief, Jamie Dimon, normally leads the war on regulation. But now he's on a campaign of damage limitation. And on Sunday's edition of the US network show Meet the Press, he admitted the bank made a, quote, terrible, egregious mistake, and went on to say he does support some limited form of bank regulation.
We have supported 70% or so of Dodd-Frank. We supported resolution authority. We supported higher capital and liquidity. JPMorgan always had a higher capital and liquidity. That's partially to make up for mistakes and problems. And, obviously it's a tough economy. We support an oversight committee. We supported some of the new compensation rules that we already followed, most of them. So we support a lot of it.
So, are politicians in Washington serious about introducing federal regulation of financial institutions? And does the JPMorgan Chase announcement settle the debate on whether Wall Street needs more regulation? To discuss this, we're joined by Mark Calabria. He's the Director of Financial Regulation Studies at the Cato Institute here in Washington, D.C. He was also a senior staffer on the U.S. Senate Committee on Banking. In Los Angeles, we have Robert Scheer, a journalist, now the editor-in-chief of the online news website truthdig.com. He's the author of the book entitled The Great American Stick-Up: How Reagan Republicans and Clinton Democrats Enriched Wall Street While Mugging Main Street. And Bartlett Naylor is financial policy advocate at Public Citizen, an organization which campaigns on behalf of citizens' interests before Congress. He's also the former chief of investigations at the U.S. Senate Banking Committee. Bartlett Naylor, then, first of all, are we entirely clear, first of all, as to what exactly happened with this JPMorgan trading loss?
I believe that much of what American policymakers need to understand is clear. This was a massive gamble on a large notional value of derivatives that proved egregiously wrong in the bank's own estimation. And I think it argues very strongly, very forcefully for the need to take some of these decisions out of the bankers' hands, provided that there is an ongoing, implicit, almost explicit taxpayer subsidy that is underwriting such gamble.
But are there, there seems to be some debate as to whether this was actually hedging or whether this was simply a bad investment and so forth. Are all those parameters becoming clear, though?
It's a good point that a number of questions need to be answered specifically. The nature of the legal nature of the affiliate of JPMorgan, for example. Was it truly a London subsidiary, or was it literally an office of the New York-based chief investment office? There are questions as to what was the nature of the transaction. Was it a hedge or a secondary hedge, for example? Did it conform with the Volcker Rule? Did it conform with the Volcker Rule as proposed, or as should be improved by the elimination of portfolio hedging, for example.
Actually, look, this is part of the problem, isn't it? We're already now using terms which
right.
Unless you're closely looking at the sort of debates going on about Wall Street regulation, you may have a problem with. But we'll try and define some of those terms in a moment. But first of all, Mark Calabria, from your point of view, do you accept this is another example of the system failing?
I don't, because one, my standard is not that we never make mistakes. Banks, regulators, I made 10 mistakes this morning, that's just today. So I think you cannot have a system that starts from the assumption that the system falls apart every time it makes a mistake. This is the way the system's supposed to work. Somebody screwed up, that entity bore the costs of that. What I think this really says is we can allow investment banks to take multi-billion-dollar losses without having to have the taxpayer cover those losses, and the world continues. We didn't have a financial Armageddon. The system did not shut down. And so I think this proves that, the throwing money at the banking industry, which is the heart of Dodd-Frank, which is the heart of the approach to the financial crisis, is not what we need to do. The losses and bets need to be aligned in the same party. So I think this is the way it worked. And more importantly, the responsible parties were fired. I have yet to see one government official, Congress, executive branch, regulators who were asleep on the wheel lose their job. This is the way it's supposed to work.
Robert Scheer, does that reassure you?
No, not at all. Look, I think we should cut to the chase here. The reason the terms are mystifying to people is, first of all, they didn't exist during most of the history of capitalism. These financial derivatives were an invention of the 1990s. These gimmicks, these scams, the collateralized debt obligations, the credit default swaps, and the justification for not regulating. After all, Wall Street lobbied fiercely to get the Commodity Futures Modernization Act that the Republicans in Congress wanted, and Bill Clinton signed off on in 2000, the year after they reversed Glass-Steagall, preventing commercial banks and investment banks from merging. And the argument was, these are people who know what they're doing, they're handling their own money, there are no victims here, and it's very complicated. And so we got into hundreds of trillions of dollars of notional value of these things. And this case here with JPMorgan is very similar to what happened to AIG. The money is flowing in through some London office of people selling this stuff, the credit default swaps, bets on bets of packages that are not understood. And the people back in the Home Office welcome the money, and it's too good to check. They don't want to ask tough questions. And the specific deregulation they got that allowed all this, the Commodity Futures Modernization Act, in Titles 3 and 4, in very clear language, said no government law or existing regulatory agency will have any survey power, any power over these financial derivatives. And that has turned out to be an absolute disaster for the world's economy.
Now there have been attempts.
The irony here, I'm sorry?
No, go very quickly. What's the irony, Robert?
The irony here is that Jamie Dimon happens to be one of those guys who was closest to the president. They know each other from Chicago. This is a bank that gave money to Democrats, not just Republicans. And he had outsized influence in the shaping of the new regulatory atmosphere. And unfortunately, he was a key figure in watering down Dodd-Frank to be a meaningless piece of legislation.
But there have been these attempts at regulation. Carl Levin, a Democratic U.S. Senator from Michigan,
yes,
has lobbied for financial reform. He was on Sunday's edition of Meet the Press as well. Here's what he said should be done now in the light of this latest loss.
And if we can prevent these kind of bets from being made, we can avoid ever again having to bail out banks. We bailed out this bank. Tens of billions of dollars went to this bank before, and we don't want that to happen again. And that's why the regulators have got to be strong. Right. We can't allow Wall Street to undermine the regulation which must be written if we're going to carry out the language, the specific language which is clear on this in the Volcker Rule.
Bartlett Naylor, let's go back then to this idea of the Volcker Rule. Would actually the legislation as it was written and passed have prevented this from happening? Or are things being watered down, even probably at this moment, actually, in Congress, and this week, in fact, are going to be watered down further? So it wouldn't have made much of a difference anyway.
No, it would. The Volcker Rule, Section 619 of the Dodd-Frank Wall Street Reform Act, says quite explicitly that there shall be no proprietary trading. That is to say, the bank shall not expose its own capital for the chance of a short-term gain. No matter how you interpret exactly what JPMorgan did, it was attempting to make money. It was attempting to deploy its own capital.
So it can only use clients' money. It can only use, but it shouldn't be using its own money.
That's right. It is able, certainly is supposed to take orders from customers if they wish to speculate with their own money. But the bank's capital is not to be deployed in the hopes of making a short-term proprietary gain.
Why should the banks be forbidden from trying to make some money, and indeed hedging even?
Yes, because, well, hedging is a different, right, exactly, is a different case. But to gamble with what is in effect taxpayer underwritten money is a service that American taxpayers certainly don't want to undertake. It led to the bailout that Senator Levin referred to for JPMorgan and for banks in general. And that's, we were promised by President Obama when he signed the Dodd-Frank Wall Street reform that never again will America be held hostage by a bank that's too big, too complex, too interconnected to fail.
Let's be very clear. I mean, the Congress, the regulators chose to take my money as a taxpayer and give it to the banks. These were bailouts of choice. They were not bailouts of necessity. I think if the Volcker rule had been in place 10 years ago, we still would have had this massive blow up our financial system. How would that have made a difference for Freddie or Fannie? How would that have made a difference for Bear Stearns? How would it have made a difference for Lehman? It wouldn't have. And so what you need to do is bring market discipline. You know, I think the question earlier, Bob made a point about, you know, I mean, let's be clear. Those of us who prefer market solutions, we start from the assumption that nobody knows what they're doing. Bankers, regulators. The point is, how do you align incentives? And so I do think we need to tie the hands of the Treasury, of New York Fed, who keep wanting to throw my tax dollars at these entities. You have to let these entities fail. We will never get we will never get rid of too big to fail.
What's a bank for exactly? I mean, don't you have to then say, well, what is? Should a bank then should it be helping other entities make investments, or should it be making investments of its own money to try and make a huge profit?
Let's look at the S&L crisis. No Wall Street. Thousands of small banks went out of business from gambling by making loans. Every financial decision is a gamble. And I think it's an arbitrary distinction to say that this credit default swap is a really big gamble, whereas, because I remember, I was on the Hill trying to regulate Freddie and Fannie. What I repeatedly heard was, oh, it's residential mortgages, there's nothing safer than that, don't look here, nothing to worry about, despite the fact that their off-balance sheet guarantees were leveraged 200 to 1. And the very same people, Mr. Dodd and Mr. Frank, who told us they were going to fix the system, were protecting these entities. And so I'd certainly say it's too much influence by the special interests in here, but the ultimate, where we need to go is to align the incentives correctly so that those who take the gambles are those who take the loss, and we need to make sure that that is true throughout the financial system, and it's also true on the regulatory side as well as the bankers. So I worry about a lot of the discussion about the Volcker rule. To me, I mean, even Paul Volcker said when he testified before the Senate Banking Committee and asked, would this have made a difference in the last crisis, he said no.
But perhaps because he said it wasn't perhaps as simple enough. I mean, you mentioned Glass-Steagall. Robert Scheer, go ahead, though. Yes.
Yeah, I'd like to bounce in here. I think, sure, if we had Adam Smith's free market where no one could control it and you know, people, you sink or swim depending on your success, yes, that would be a far better world. But we have crony capitalism. You know, we have a system where Wall Street got to write the laws. And they got to write the, you know, if the mafia got to write the laws, loan sharking would be legal, and we'd have a lot of trouble in that area. They got to write the laws, reversing the rules that came out of the last depression, the sensible rules of the road, demanding transparency, accountability, oversight. That was all swept away with the reversal of Glass-Steagall and the Commodity Futures Modernization Act. Said, no, let the game go on. These people know what they're doing. The adults are watching the store. They're not risking other people's money. Well, all of that turned out to be false. Allowing investment banks and commercial banks to merge put at risk federally guaranteed savings of people. The fact is, these banks are being bailed out at this very moment, not through the direct bailouts, but keeping money, the money that they borrow, not the money that students borrow or people. Some people are paying 30% interest on their credit cards. The banks are getting money for next to nothing, and it's predicted they'll get it for next to nothing for the next 3 years.
But is it easy enough then,
subsidizing the financial. Yeah.
Is it easy enough then, as I think Mark Calabria was suggesting then, is to say, well, look, let's take that issue of a government guarantee out of the equation and then just let them fail? Would that be enough for them to stop all of us being beholden, perhaps, and at risk?
Yes. If we could reverse the history of the last 100 years of capitalism and say, you know, everyone will have perfect knowledge, no one will control the market, there will be no concentration of wealth, there will be no lobbying. Yes, you could come up with a better system. But the world that we live in, Jamie Dimon was able to go to Washington and meet with the top regulators and the top people in government and say, no, we want this rule, not that rule. And we know what we're doing, and you have to put this loophole in. And they put a loophole in, as Carl Levin has agreed. They did, and they drove right through it. And so the fact is that we have our government at the service of Wall Street. And then people like well-intentioned people from Cato and others come along and say, well, we'd like Wall Street to be on its own, but it's not on its own. They know darn well that they're going to be bailed out by Washington. They're being bailed out by Washington today. If they had to pay the same rate for money that the rest of us consumers have to pay, they would be out of business. So they are being floated.
It's a lovely idea, but the fact is we don't have a society in which
the
market forces are simply going to be the only.
I think the question is how to get there. I'm agreeing that that's the world we're in, and I think the choice that's facing us is whether we think we can continue to put more faith and discretion in regulators who, in my opinion, have repeatedly failed. Now, I'm not giving up. My proudest moment was working on the banking committee for Senator Shelby. We went down and opposed the TARP, fought our own president, trying to make sure this bailout wasn't done. So I do think that I'm not giving up on getting rid of bailouts yet. I'm not accepting that a world where we're going to throw money at these guys, and I want to work toward that world. So I appreciate the point that we're not in that world, nor are we in the world where the regulators are going to get the right thing. But I want to emphasize a final point, though. Two of us here have served on staff of the banking committee. We've spent a number of years being lobbied by bankers, lobbied by all sorts of groups. What you need to have is the members, senators, congressmen, staff sit there. I threw a number of bankers out of my office on more than one occasion saying we're not going to do that. And so you do need to get the right people in office, but I never think that's going to be enough.
Let's just look at the world as it is in that case then. I mean, how much do banks like JPMorgan spend lobbying in Washington? Commercial banks spent nearly $62 million on lobbying last year. If this $8.5 million came from the American Bankers Association, but if individual banks, Wells Fargo spent $7.8 million, JPMorgan Chase $7.6 million, Citigroup spent $5 million, and it would appear that a great deal of this, Bartlett Naylor, has been about watering down the Dodd-Frank rule. And in fact, this week, some legislation is coming up for consideration that would have had a direct bearing on what happened at JPMorgan Chase. What was that?
Yeah, that's right. The bills that are coming up this Thursday have to do with diffusing, emasculating several sections. Just to back up and put it into context, as a lobbyist trying to represent consumers, I know entirely the universe of my peers who are fighting on that side. We are outnumbered 150 to 1. There were 3,000 to 4,000 Wall Street lobbyists, very well paid, very well educated, very hardworking. The regulators suffer what I would call Stockholm syndrome. They'll have 100 meetings, and 99 of them are going to be from bankers. So they are themselves beginning essentially to parrot what they hear from the bankers. So the lawmakers, the regulators are all infused, flooded, if you will, with what Wall Street's message is. What the members of Congress are trying to do is win a free vote, win some free money from Wall Street campaign contributors, which are very generous, as you've just pointed out. And they are hoping that the complexity of the bills being voted on this Thursday are misunderstood or not understood by the American public. The benefit of this Morgan catastrophe is it shows exactly what these bills could do in a bad scenario. When you have the nation's most well-managed risk managing firm able to lose $2 billion, then what about the average firm?
And indeed, whether there's more to come, actually, from JPMorgan Chase, perhaps, as well. But, I mean, that's the point. So, basically, we had this Dodd-Frank bill passed, and then it's been sort of a death by 1,000 cuts in some ways. I mean, all these other bills have sort of now come up which neuter little bits of it. Is that what's been going on?
That's right. Well, I would call it the quadra-kill.
Sorry, Robert Scheer, we'll get to you in a second. This is the quadra-kill very quickly.
Well, the quadra-kill is we pass laws that diffuse, we sue over the implementation, such as cost-benefit analysis, we flood the regulators, and we elect new congresspersons to get the bills that we want.
Robert Scheer.
Yeah, I just want to mention, I didn't work on one of the banking committees. Phil Graham, who headed the chief Republican who headed the bank committee, went to work for UBS, which ran into their own trouble. Wendy Graham, his wife, who was the head of the Commodity Futures Trading Commission, went to work for Enron, which went belly up. So the people on those committees go through a platinum revolving door and do quite well. But as a journalist for the Los Angeles Times, when the deregulation was put in place, there was almost no consumer presence. You were told by a congressman, including Barney Frank, including Democrats as well as Republicans, go talk to that wonderful fellow. Well, the wonderful fellow would turn out to be a lobbyist. And the power of money to shape this legislation is so far removed from this world, this idealized world of Adam Smith. It's absurd. It has nothing to do with it. These people, you know, as I say, the analogy with the mafia is well placed. These people get to write laws that make what should be clearly illegal activity legal. they get this respectability for it. And there's no transparency, there's no accountability, there's no serious regulation. And what you really have to do, the clearest thing you could do, John McCain actually advocated this briefly, why not reverse why not put Glass-Steagall back in place?
Why not, though?
Why not reverse the Commodity Futures Modernization Act? Why not have accountability?
Why not just have a simple separation then between commercial and investment banking as envisioned by what's known as the Glass-Steagall Act?
There is no good reason not to do that. We should restore Glass-Steagall.
Let me start, and I think it's interesting. I want to emphasize, I mean, I'll be the first one to admit that I start from the assumption that I want to end bailouts, and I recognize my colleagues start from the assumption that we're never going to be able to do that. It's interesting that I also start from the assumption that the process is always going to be captured by the special interests and corrupted, and so my colleagues start from the assumption that we can change that. So I think the empirical question here is, which of those two assumptions really is going to be strongest in the long run? I'll be the first to say I don't know, but I think that's what we should be trying to figure out.
But in the meantime, there's economic chaos.
Absolutely. But so I do think we need to do, absolutely, we need reform. I think we need to reform more than Dodd-Frank. I think Dodd-Frank ignored most of the core problems in the crisis. My concern about, again, Glass-Steagall is that, for the most part, and look at the savings and loan crisis. None of those were investment banks. Most of the banks
But this would be one plank, then, of economic instability at the very least.
What we should start with, the one plank, is there had been rules in place that had holes in them that limited the amount that any one bank could have with the Federal Deposit Insurance Corporation. And right now it's 10%. You used to be able to grow beyond that and merger. We need to shrink that. We need to minimize the risk of the Deposit Insurance Fund. Any one bank. I would make it 5%. That no one bank could be more than 5%.
Is this all proof, though, that regulation is completely the wrong? I mean, yeah, maybe you're right. Regulation will never work. So actually, the only way to do it really is just to break up these banks in the first place.
Well, and I'm sympathetic to that, but I think it's harder said than done, because where do you draw the line? Where's the credibility? I mean, I don't know anybody personally who thought Bear Stearns was too big to fail ex ante. It really was after the fact that we came in and threw money at it. So I'm just not.
MF Global had $60 or so billion in assets. Its failure did not disrupt the world economy. Lehman Brothers had $800 billion, and it did. So somewhere between there, I think, is the line.
Robert Scheer?
I just want to make a point about regulation. We have lots of regulation of every aspect of the life. If you don't make your home payments and the bank forecloses on you, a sheriff will show up and throw you out of your house if you don't leave. Government will intervene to enforce those mortgages. Government will intervene to make the banks whole. Ordinary people who can't pay their credit cards when the interest goes up to 30, 35% because they missed some payments, their credit is going to be hurt. They can't buy a car. They can't do A, B, C, D, and that is enforced by government. So government comes down quite viciously when it comes to ordinary consumers who are being screwed by the system. But when we try to have the most tepid restraints on these Wall Street monsters, which they are, these huge corporations that are totally out of control, are operating throughout the world, care nothing at all about the interests of ordinary Americans, are callous with their savings and their jobs, and then you try to have the most modest regulation of what they do, at least have transparency, at least understand what's going on, accountability, but they cry foul.
Where are we right now,
That's the real heart of the matter. It's a double standard.
Even with what you call the tepid regulations, Bartlett Naylor, then, I mean, is the Volcker rule going to come into effect on July the 21st, 2012? Was part of the problem that even Dodd-Frank, to a lesser extent, were being lobbied heavily by the banking industry and so on. So you're never going to get perhaps a return to Glass-Steagall. Was that the only problem then, or let alone a breakup of the banks? I mean, what's going on?
Volcker rule makes a good politically best case chance at trying to do one of the three things that you can do to make banks safer. Senator Shelby, for example, proposed breaking up the banks. You could also have vastly increased capital. And the other one is an activity restriction, which the Volcker rule attempts to do. Legally, the Volcker rule, final rule is due July. Compliance is due 2 years after that. There are some.
And are you expecting this to happen then?
We hope that it will
Why are the
happen.
five biggest banks bigger now than at the beginning of the crisis?
Well, they're bigger largely because a Federal Reserve person who's now the Treasury Secretary basically played playing cards with the crisis. He said, all right, Wachovia is in trouble, let's find somebody. We'll have that be Wells Fargo. And Bear Stearns is in trouble, and so is Washington Mutual. So let's join that with JPMorgan. And so these companies did not grow to the mega size they are because of just internal growth. They grew most precipitously in 2008, 2007, when they were merged together with taxpayer assistance.
If I can make a point, I mean, quite often we're presented with it's either bail out or liquidate, and I think Lehman is a good example where Barclays bought the North American operations, Nomura bought the Asian operations. When you take one of these banks into a bankruptcy or a receivership, because WAMU actually worked, we impose losses on creditors in WAMU, and that's the way you're supposed to do it. That is the way that will break up these institutions when they get in trouble, and that's the way it should have been done.
Robert Scheer, last word then. I mean, is that the way then? Do you see much hope for proper safeguards, and do the Democrats or the Republicans make much of a difference depending on will this outcome of this election make a difference?
I think the political system is broken, and I think the Citizens United decision puts the big nail in the coffin, that money controls this. And here you have both Democratic and Republican administrations threw all this money at Wall Street to make Wall Street whole and got nothing back for the homeowners, got nothing back in terms of mortgage relief, helping ordinary people out. There was no bailout for ordinary Americans. And that is the real issue. And yet we still listen to these thieves on Wall Street as to what to do. They've still got credibility. Why? Because they still have the big money.
Robert Scheer, thank you very much. Mark Calabria, thank you. Bartlett Naylor, thank you very much too. That's all from the team in Washington, D.C. for now. Don't forget to follow us on Twitter and Facebook, where you can find more information about the program. And we want to hear from you. Tell us what stories you think we should be covering. Send your ideas directly to us at InsideStory@aljazeera.net.